Good afternoon, everyone. There's nothing quite like the Friday afternoon 4 o'clock slot to talk about machine learning, but I think we've got a really exciting conversation for you today. And as everyone probably knows well here, machine learning and AI are all around us in everything that we do. We're seeing it in multiple industries. We're seeing it being used across risk, helping us make decisions more quickly, helping us really assess risk, and ultimately helping humans make better decisions. And so I think as we think about machine learning and we think about the method of data analysis that really automates all of this analytical modeling, I think it's important for us to recognize that there are many parts to this. It's not just the model itself. It's the data. It's the human interaction with the model. It's interpreting the model. It's the skepticism with the model after you interpret the results. It's a series of things. And although a lot of us like to think it's magic, it's not magic. It's really just a method to help us move forward and arrive at better decisions. And it doesn't happen without humans being involved in some way. And so maybe, as Brad mentioned, it's been a busy week. Maybe I can start with you, Tom. You've had an exciting week. You've had, earlier this week, the Bank of England and the Financial Conduct Authority published the findings of a joint survey where nearly 300 firms, including banks, creditors, investment managers, and others, were really asked about their use of machine learning. And there were some interesting insights. One of the ones I took away, and quite frankly was shocked, was that 2/3 of the respondents said they are already using machine learning in some way. And that, to me, as someone who's using machine learning in our business, I'm a little bit surprised. We go out and talk to a lot of customers. It's new, but over the last couple of years, it's absolutely taken off. So maybe talk a little bit about the study and what you found interesting.
So I think we were surprised as well, Nick, but pleasantly surprised, actually, because we really see machine learning as being something which can improve finance. It can give customers products which are more tailored, more customized. It can help financial services businesses be more efficient, more effective. It can help them have better control of their risks. So we were surprised that 2/3 were using it in the UK, but actually we thought that was largely a good thing. What we were struck by was that the firms were being quite cautious about it. Clearly a big stake in the future with use of machine learning. So they expected that broadly the number of applications they would have would double in the next 3 years. But they were also treading quite carefully a number of constraints inside their own businesses in terms of access to skills, understanding and ability to validate the models, and actually just really wanting to understand how they would fit in their businesses and make a difference. So a lot of interest, a lot of positives from machine learning, but certainly not a kind of rise of the robot situation. Firms are definitely being deliberate, they're being strategic, but they're also being quite gradual about this. We really do focus on the benefits because we think machine learning can make a big difference. We put out the Future of Finance report, which Hugh Van Steenis spoke about earlier today. And in that, we really said that actually these new, innovative, quite transformational general purpose technologies will make a big difference to how finance works for the end user. So we should be really embracing this. But our job as regulators is also to worry about things. We're kind of professional worriers. And it was really reassuring, actually, to see that firms themselves were saying, we appreciate this could amplify existing risks, and we need to understand how to make sure that these models, where machine learning is being deployed, are properly validated, are properly understood, and we can explain both the inputs and the outputs.
That's great. You talked about many of the banks think that they're going to double their use of this technology or this practice going forward. Are there particular areas that they're really focused on? Is it more around credit risk? Is it more around driving alpha? Are they looking at particular areas within the bank or within the insurance company to really drive the practice? Or is it really a host of different applications?
So what I think was really interesting, actually, is we saw quite a broad spread. So we clearly saw AML, CTF as the most kind of developed application of machine learning. That was no surprise to us. But what we saw was actually quite interesting deployment in areas like customer engagement, customer service, front office activities like credit, like trading. And actually, that was quite an interesting spread. The other thing which I found really interesting, actually, was that the insurance sector were really using this technology in quite an advanced way. So it's not just a banking thing, it's present in insurance. And actually, I think that's really encouraging for financial services to see that a lot of the sectors in finance are getting involved in this technology.
That's great. Rob, I know you, in your role, maybe representing the technology, the platform, and what you do, you work with a lot of banks, you work with a lot of insurance companies, people across financial service industries. You see a lot of different applications. You know, as you think about this study and you think about, you know, going forward and what you're doing, what are some of the applications you're seeing not only in the UK but more broadly across the market?
Sure.
And maybe talk a little bit about when you see those projects that are spinning up, what are some things that are going well with those projects, and maybe what are some things that, you know, have you concerned?
Sure. So let me break that down a little bit, Nick. I think in terms of where we're seeing it, it actually mirrors, I think, closely the study from the Bank of England in that we see it across the gamut. So at DataRobot, we have hundreds of clients using this and thousands of use cases. Our clients are spinning up 2.5 million models a day just in our hosted version. That doesn't include all of the clients, which the majority of financial services have us installed on their site. So over 1.5 billion models have been built on the DataRobot platform, and that increases all the time, but it is across the spectrum. To Tom's point, I think that we are seeing exactly that. There's a strong use case in the Anti-Money Laundering, Bank Secrecy Act, fraud detection, those types of areas, and also on the customer side as well. And it's kind of funny because those are what I would call the barbells of the business, right? We're talking about sort of the real core of the business and identifying fraudulent transactions and risk, but also helping the customer experience. And we see in both areas and everything in the middle. We see within financial services, it usually comes from one of those two places and then spreads out to the organization. And it goes from the front office, middle, back office, and out to the client servicing side, whether it's institutional or retail clients in terms of how they're serving it. So it does run the gamut, and we're seeing, not a big surprise, I think, the areas within the financial services firms that are more lending themselves to the quantitative side of the business pick it up faster. So in the investment management side of the business, we see a lot of the quantitative investing companies or departments that are actually used to quantitative methodologies and automated machine learning. They're deploying it in their spaces and then spreading it out. So it really does run the gamut, but it usually has a starting point that's very specific, trying to solve a specific business problem. To answer your second question about, what are some of the things that we're seeing as they get rolled out, I think we might get into some of this a little bit later, but at a very high level, we're seeing, some of the successes that really have, it always starts, the most successful ones always start with a business problem that's trying to be solved, always. There is a lot of data science, I think, that's taken place in machine learning that has been sort of experimental. And experiments, we've talked about this, it's a good thing. It allows firms to understand and try new things out and test the boundaries of what they can do. On the other hand, if there's no business problem you're trying to solve at the end of the day, it's not going to get the support from above, and so it doesn't happen. So I would say that's one. It has to have a business problem to solve. The second one is, for firms that are new to machine learning and ones that haven't tried it out, it's solve a simple one. Don't try to do quantum physics with machine learning. It's really try to take a simple business problem, and something like AML sounds like it might not be so simple, but it lends itself so well to machine learning that it typically is a simple solution for firms that are just trying to get going because there are so many prior proof points in those. So those are some of the successes. On the failure side, it's pretty squarely rooted in lack of executive sponsorship, and there's in our view, an education gap there right now at the very senior levels, at the C-level. Outside of risk management, there are pockets where they completely get machine learning and the advantages of it, which is, in the chief risk office in those areas and the head of quantitative investing, head of actuary in an insurance company. But by and large, if they are not a quantitatively driven C-level executive, the education has to be ramped up there in terms of what AI can do for them in machine learning.
That's great. I'm curious, maybe, Natalia, if we could kind of pivot a little bit. I mean, Rob mentioned millions of these models being spun up very quickly. And I know there's some concerns. As Brad mentioned, that you just released the second edition of your report on the use of machine learning. And you talked about, the report noted that supervisory understanding and consent is an issue and is important. And people kind of want to understand, what does it mean now that we have all these models going forward? Could you talk a little bit about that and maybe some of your concerns when you see the large numbers of models that are spinning up?
Sure. So maybe I'll start out just giving a little bit of a background that what the IAF has done for those that are here that are not familiar with it. So in 2018, the IAF did a survey looking at machine learning in credit risk. We published it on March 2018. We looked at different criteria within that. We looked at how banks were using machine learning, the applications, the credit risk functions, the techniques, the algorithms. We also looked at the benefits and the challenges. We had a globally diverse sample of 60 firms. 58 of those were banks, 2 were mortgage insurers. So this time around this year, we published the second edition of that report. We looked at fewer criteria. We still focus on the areas of application, the credit risk functions, the techniques. We didn't go as deep into looking at the specific algorithms, although that came up in a lot of our discussions. And we looked at the benefits and the challenges. We had 60 firms this time around again. 56 of them, or 55 of them, were on the original survey. So what we were able to do was look at that continuation, that progression. We were able to assess how those firms had progressed in the last 18 months. So I'll talk about the supervisory point before I talk about some of the things that I found very interesting in the report. So on the supervisory point, one of the questions we asked was whether was on challenges. And one of the options that was given was supervisory understanding or consent to use new processes. And in our survey, 80% of respondents selected that option. So it was surprising to us because 80% is a big percentage on that sample. Mm-hmm. But in our conversations, we had a lot of interviews with banks. What we saw is that it was mostly supervisory upscaling. I think now machine learning is something that supervisors and regulators are more aware of. And so what we saw is that they are asking the right questions. Like they are scrutinizing those models in a better way. And we saw that as something positive because banks don't want, or insurers don't want to go and talk to their supervisor or their regulator and them saying no just because they don't understand it. So that's, to us, a positive development. And in terms of what I found interesting, it echoes a little bit of what you both already touched on. So in our sample, I believe 85% are either using machine learning in production or in a pilot project. That is a 49% increase in comparison with our results from 2018. And you think about it, it's only been 18 months. So for me, one of the main takeaways was when I was having these conversations with institutions, it wasn't anymore about should they be using machine learning, but it was about when and how they should be using machine learning. And then the second thing that I also found very striking was in 2018, it was predominantly retail, the retail sector. And in this year's result, we saw there is an increase from 4% or actually 8% in 2018 to 40% this year on the use of machine learning in the SME sector. So we actually believe that if we were to do the survey again next year, we'll see that these firms have progressed into other sectors outside of retail. We are already seeing some of that being used for other purposes outside of just the retail sector in SMEs as well as corporates. And I'll mention one third point, I don't take all the time here. And it echoes a little bit of, again, what you've mentioned. So credit scoring and decisioning continues to be the main area in which firms are using machine learning in credit risk. Having said that, in our 2018 results, we saw as well that there was some use for regulatory capital, economic capital, provisioning. It was very low. And in this year's results, we've seen a move away from those sectors to sectors that are where they can actually have a problem that they can solve. So I see very much, and I agree, that firms have taken this more of a problem-centric approach to their use of machine learning. They have strategically decided to move away from sections with areas within credit risk where the chances of them having a successful application of machine learning may not be as profitable for them, and they've moved into credit scoring and decisioning that has increased dramatically, and also they've moved into credit monitoring, including looking at early warning systems, and there's some collections as well. So I'll pause there. I mean, I can talk about it for a full hour, but I won't.
No, that's great. That's great. So, I mean, it's really helpful. I mean, I think, the one theme that I'm hearing already that's coming up consistently is that we really need to make sure that we're not focused on machine learning for technology's sake, but we're trying to solve client problems. We're trying to solve business problems, that we have a hypothesis that we're trying to either prove or in some cases disprove. We have to find the problem. The one thing I haven't heard yet, and being from S&P Global and being a data geek, I'm a little bit surprised. And so Max, I'm going to turn to you to talk a little bit about this. I mean, the model is one thing, but the data that we use and we put through the model is critically important. And again, being a data geek at heart, I tend to think a lot starts and stops with the data, and it does have a profound impact on the model. Maybe, from your perspective as a practitioner, Magnus, can you talk a little bit about the data and the models and what you're seeing in the industry? Maybe some wins and some pitfalls.
Well, maybe the easiest way for me, at least, is to tell you a couple of stories.
Sure.
Right? And the first story is of how we built, let's call it corporate credit models, probably right now around 7-8 years ago. And it started with us in our bank, SEB. We have a very seasoned credit officer. His name is Lars Olsson. You can go to Lasse and you can ask him, so what do you think is dangerous for this company? So a typical model build, or classical model build, starts with talking to experienced people and asking them, what are the factors that you need to look out for, right? Typically for corporate, you get high leverage is bad. It's dangerous. So we put in a factor which we call leverage, and then we do a regression on all of our counterparties. And then we check, have they defaulted or not? And this is what we call a single factor analysis. So the data that we need for that is based on the human imagination, right? And you track the data, and usually that's something that we tracked in the past. Then what you do is you combine the factors, you do a multi-factor analysis. And then it's also, again, human imagination that goes into what are the ratios, what are the different combinations, and you end up building thousands of models almost by hand, and then you choose the one which has got good accuracy and is understandable for the human being. So when the credit officer or the front office, when they sit down with customers, they can actually explain to the customer and explain to themselves, so why do we think this is a good or a bad credit, right? That's how we built models, and it works pretty well. This is the foundation of credit decisions today. That's the story of how we used to do this. Then we have a segment, which we call them solopreneurs. I don't know what they're called in the US. It's individuals that have a company, and the problem with them is that you do not have a predictable income. They do not have a salary, they are contractors or whatever they are. So extending credit to them is really difficult, because typically you want to understand, are they able to pay back the loan, and you need to have cash flow to do that. So what we did using machine learning, and here the trick is, what these machine learning engines kind of do is exactly what we used to do with talking to Lasse, and then creating all of these single factors and then combining them. It just does it more or less automatically. It employs different ratios and employs different models, and you end up with something which is sometimes quite beautiful. But the data you need for that, therefore, needs to be both bigger and it needs to be correct. Because at every point in time that we did this 7 years ago, we had a human being that looked at it and said, does this make sense or not? And when you're running these engines, you don't have that. You have an engine that runs things, right? Now, what we included in the build for that solopreneurs models were data that that the human mind couldn't comprehend. We took all of the transactions that those human beings had been doing for the last 10 years. You take non-credit related data, you take all the traditional credit data. It was all combined. We ended up with a model that has accuracy ratio which is comparable to the best that we had. But traditionally, we weren't able to do that. So you can get, from a risk perspective, dimensionality, which is better than you used to be. The explainability and the probability of a regulator approving this is not that great. So probably you will have standardized capital requirements, but decision models underneath, because we're not in the business of being capital efficient. We're in the business of making the right decisions, right? But the underneath is just as you said, an enormous amount of data. And suddenly you end up in some of the transactional data comes out of credit cards, some of the transactional data comes out of, all of this is in different systems. It's possibly in different divisions. It's possibly with different definitions. It's different timestamps. It becomes quite unwieldy. So building that model for the solopreneurs, 80-90% of the time went into cleaning up, making sure it works, making sure that we know what data it is and where it comes from, how it is. The actual build of the model was not that complicated. And that's kind of, in history that doesn't change either, but it creates a lot of different type of work, and it's more complicated because it's so much more data. And then it gets into questions like, should we be using where they live? Should we be using non-traditional data like Facebook data, all of these kinds of things? Most of the time we choose not to do that because A, we don't need it, but B, it creates all sorts of other problems that have to do with data ethics and privacy and stuff.
And how do you deal with, I mean, in much of this data, it's spotty. You might not have history at certain times. It starts, it stops. You might be using it today, but then you can't get it tomorrow. Do you use machine learning and artificial intelligence to help fill in the gaps and actually clean some of the data before you can do the models for those sole proprietors?
We're beginning to do that, and that proved quite successful. Mostly in, let's call it, identifying anomalous data. We're filling it in, we've not been brave enough to do anything like that.
Right. And the models themselves, you mentioned explainability. You want to make it so that someone can go out, sit across from the customer and explain what the model did. I mean, do you do anything special to make sure that the models are transparent and you can explain them?
Yeah, well, special. At the end of it, we put human beings in front of it with experience, that the end result is something that we do understand. So it's, and the purpose of that is really just this point, being able to make the right decision, not necessarily to have the statistically perfect model, but such that you can actually scrutinize it. And sometimes you need, well, AI is not yet, doesn't yet have common sense.
Right.
It's just a series of algorithms or deep neural networks to solve a single problem, right?
Right.
So getting that overview, we're still not letting go of.
It's interesting, and I think that's an important point that I've noticed too. A lot of people overlook that, again, it's not magic. Artificial intelligence is not there. It can't replace common sense. You still need subject matter experts. You still need business experts to understand the data, understand the output, and really be skeptical of the output in many ways. Ask a lot of questions about, is this right? Does this look right?
But it comes up with factors and features and parameters that the human mind doesn't imagine. So it's that extra imagination that kind of is a little bit cool.
Yeah, no, definitely, definitely. I'm curious, and I'll open this up to everyone, as you look at different projects and from your experiences, maybe share from the group, in addition to what we've already talked about, some words of advice when you're thinking about taking on one of these projects. We talked about it being founded in a business problem. We talked about making sure you understand the data and you have humans involved, you can explain it. But we've all seen, and the roads are littered with tons of projects that were not successful, or that maybe we thought we had an hypothesis that we could test for, find a pattern and find a result, but at the end of the day we couldn't. Are there words of advice for people who are thinking about taking this on for credit risk or thinking about using models in new ways for the financial sector? Anything you would add?
I'm sorry for jumping in, but one of the cool things that we did, I thought it was kind of cool at least, was that we ran this same kind of engine on our current mortgage scoring model as a challenger model. And it comes out that it says exactly the same factors, right? And in a way it's a non-result, but in a way it's kind of cool because it tells you what you're doing right now is it's fine. But running these engines on something that you already have can give you the confidence that it actually works, and then you can take it to the next step. That's a little bit of where we started.
That's great. Yeah, that's a critical point. Absolutely, having that, almost that training data, having the answer key where you can run it and validate is critically important.
Yeah, I mean, I'd agree with that, Nick. I think from what we see in terms of what it takes to have a successful launch. I talked a little bit about it, but it's picking the right solution, because so much of this is, there are a lot of skeptics. There are a lot of machine learning and AI skeptics still out there, despite the adoption that we're seeing of 80% and 60% and so forth. You need a quick win, which means that pick something that's there. The other side of it is that, back to your question about the data and the pre-processing, we are seeing a lot of our clients that are recognizing that the data does not need to be pristine in order to be useful in a machine learning algorithm. Doesn't need to be pristine. Has to be good, has to be accurate, has to be correct, but not pristine. And that's sort of a big difference in that they are using machine learning capabilities in order to do things like compute missing values and feature engineer to bring strength to the model. So there are ways that machine learning is actually being applied to the data cleansing process. It's not core to that, but I think it's a result of that, because once the outputs are looked at, and the way our platform works is, we can produce 30 or 40 models in a matter of about 20 minutes, where, a typical doing that by hand in an unautomated fashion takes a longer time. So there's more room for experimentation. And that really opens up the imagination to what can be done. Things that people just wouldn't even dream of doing. No data scientist is going to say, let me build 30 or 40 models and see which one works best. Right. They'd be fired before they get to model 4. So what
we've had a lot of fun along the way.
They have a lot of fun. Absolutely, they do. And that's lent itself to, okay, this is no longer a lab exercise. This is now, we can now solve business problems because we can do this experimentation in a much more rapid development way. So I think that's the other big thing that we're seeing. One last quick point, it gets to Magnus's point about deploying. Actually, Natalia, you said the same thing about how many of these actually get into production. And we actually believe that the next biggest wave in machine learning is what's deemed ML ops, machine learning ops, which is productionalizing and industrializing machine learning models. In other words, putting them into a production environment and looking for things like model decay and data drift so that you can keep your models updated and accurate. And in our view, that has to be part of the whole package. It has to go from pre-processing of data, imputing missing values, feature engineering, all the way through to putting it in production and monitoring and managing those models. I think that's going to really explode the landscape.
That's a point that most people kind of misunderstand, right? Is that yes, data is a lot of the work, then there's the build, and then there's the production. and
Right.
putting and monitoring and validating, and that's 90% of the total work. Building the model is a tiny piece of. So everybody says ML and AI, and they think that's it, but it's really the pre-work, and then it's the sort of. Do you deploy a mortgage model based on this? You need to train a lot of people. There are educations that need to happen, and suddenly this takes a different dimensionality to it.
Absolutely. When we think about, we've talked a little bit about some of the credit risk types of assessments. Are there non-financial risk assessments, other than AML or other than fraud detection that you're seeing or being asked for as you've either gone through the studies or built products for folks? Is there anything that comes to mind?
Yeah, well, I mean, we see, if you look at we have a matrix of all the different risks, and I think that's the first thing you have to do is define risk management. That is a very broad term, right? It could be everything from counterparty risk to credit risk to reputational risk. I mean, it runs the gamut, financial and non-financial risks. And I actually think risk and machine learning go hand in hand, because risk is about predicting outcomes and being comfortable and confident that you've got the accuracy to predict the outcomes that you do or don't want. And so it's just a natural fit for anything in risk management. So we are seeing it used in all of those. Operational risk in a big way. And it's sort of funny. I know this is a machine learning panel, but there's a discussion earlier today about RPA and robotic process automation and what that's doing for the financial services world. And we're starting to see that move towards what we're calling, or what the industry's calling, intelligent process automation, which is taking robotic process automation and adding the decisioning capability. So absolutely see it across the board in managing risk.
I think that's a great point. I mean, more and more, and we're experiencing this as well, it's these tools are very close brothers. We're using them. It's not you go one way or the other. I mean, oftentimes we're using RPA to help us get the data in the door so that we can start some of the extraction work, so then we can give it to the model so that we can arrive at the decision. And then, to your point, Max, having to put it in production, having that pipeline capability that allows you to put it in production and monitor it, really truly understand where it is, and to continue to test and refine. And in some cases, hopefully it's learning along the way so that you're refining the model as you go. It's not one technique, it's a series of techniques that really address the business problem. I think it's important when you look at the problem. I know we're running a little bit low on time, but I'm curious from each of you, a really cool machine learning application that you've seen or you've talked about. What gets you really excited about machine learning? And it can be risk related or maybe outside of the risk realm. Magnus, maybe I'll start with you and we'll work across. Does that work?
Kind of sentiment analysis, I think, is natural language processing is something that I find quite cool. It's not not necessarily completely usable yet, but it's kind of cool.
Yeah, and there's some really neat applications in that particular space. I know I've seen quite a bit of work done around sentiment analysis, around earnings transcripts, as an example, being able to go through as an earnings call is happening and create sort of that sentiment analysis and understand, well, what's going to happen to the share price after the call? How many questions did they allow to be asked during the call? How quickly did they answer them or dismiss them? And is that an indicator for a signal for maybe a share price movement? So yeah, I mean, I think there's a lot there that can be pretty interesting. There's also some noise in all of that too. Some people use that in bad ways as much as they use it in good ways. Natalia, something cool that you love?
Well, I won't mention something that is cool, but what I'll mention, and it kind of ties in with what you were discussing before, is we've been seeing a whole range of applications of machine learning, right? There are firms that have been using machine learning for longer than a decade. Those firms, they already are using more of the classical algorithms. And so now what they're doing is looking at deep neural nets, for instance, or they're looking at natural language processing together with some supervised and unsupervised machine learning techniques to improve the models that they currently have. So I'm excited to see what will come up if we were to do the survey in the next year, because I know a lot of those things are still in a pilot project. So I think I really do believe that in the next year or so, we'll see a lot of those applications, even reinforcement learning uses. We'll see a lot of those applications coming back to being used for credit scoring and decisioning, or even for creating scorecards. That there's just so many things that are right now not necessarily in production, but just in the pipeline.
That's great. Rob?
Sure, I'm going to do two quick ones because one of them is, it's not so cool other than the fact that it's incredibly practical and it's in the risk space too. We have a large global bank that used an operations analyst, not a data scientist, not somebody who really understood anything about data science, but they really understood the data on a day-to-day basis and they understood the process. And they were able to predict where they would need to have funds by country and by currency going forward based on historical patterns of where they were moving money around the world. And it wound up saving them $50 million per year in transfer fees and currency hedging. That was cool because it came out of an operations analyst that was like, if I could predict this, it would be cool. And they married that up.
That's really cool.
It's very cool.
Yeah.
The other one, really quick, just because it's more fun, is nothing to do with finance even. We actually have a large restaurant chain, that we are predicting the chicken mortality rate in transportation so that they can understand how fresh the chicken is going to be and where it needs to come from.
Well,
Not finance.
yeah.
Kind of cool.
I hope we're not having chicken later.
I won't reveal this one.
Yeah. Tom, from your perspective, something you've seen?
So two from us. So one internal to the Bank of England, and very early days, and it's unusual to call supervision or regulation cool. But as anybody who works for a bank or insurance company knows, you guys send us a lot of data. And quite often it's unstructured data because we ask all sorts of ad hoc requests. And I think NLP for us in terms of helping us interrogate that information, not to replace the human, but to actually create enough space for humans to make judgments and to eliminate some of the time which is spent doing basic data cleansing, particularly of unstructured data, I think is really important for us. And we're very much committed to trying to reduce the cost and the time taken for banks and insurers to send us information, and also for us to get back to them on that information and start asking them smart questions about it. The second one, which actually goes a lot to some of the points that Magnus has made, in the UK, we've had open banking, and I think that will expand into open finance. And following Professor Furman's digital competition review in the UK government is talking about basically a concept called smart data, which is about how can we drag all sorts of data, make it portable, so that users of finance can benefit from making their data work for them. And I think that has a really nice intersection actually with artificial intelligence, because if we're going to make big data pools available and empower people to use that data, it's going to start needing analytical techniques which can make the most of it. And I think machine learning really comes in there. And I can see some really powerful applications there because the UK has a large small business financing gap, potentially up to £22 billion. And actually, if we can start using novel data and smart analytics, including machine learning, to unlock some of the potential of those businesses to borrow and fund their productivity, that would be really cool. And I think there's a big gain there for the combination of big data and machine learning. And then also, I look at high-cost credit in the UK. So we have 5.4 million high-cost loans, usually doorstep lenders in the UK, and overdrafts, other things, in a country of 60 million people, and that doesn't really feel right to me. And many of those people, I think if they had the combination of using their own personal data, including novel data sources like search data, social media, and they could bring it into really bespoke credit assessment using things like machine learning, and actually got a loan which was a good fit for them, met their circumstances, I think that could make a huge difference to our society by starting to cut down on high-cost credit and starting to get people finance which better suits them.
Yeah. And I would add to that, I mean, I think, some of the things that I'm seeing are just really exciting. I mean, first, how these techniques are starting to move into more teams. It's not just an engineering group, or it's not just a group of statisticians that can do this. Now it's really anyone in an operations group, in a business team. They can use data in new and interesting ways because a lot of these models are now more accessible to people. We have tooling that allows us to use them, and so it really is becoming a practice for everybody's use. And I think that's really unlocking some interesting insights. You know, for us in particular, it's opening up insights in how we operate internally, but it's also opening up insights in how we can provide more data, more interesting things to clients to use to drive their business. I mean, we talk sometimes about making the impossible possible now through these techniques, where you just didn't have enough manpower, you just didn't have enough time to do it before, but these techniques open it up so you can have somebody that understands the business, now has the tooling to actually ask the right questions and come up with some interesting hypotheses. And it really becomes a force multiplier for the organization, especially if you can start to embed it at the grassroots and come up with some of those examples that people can start to build on and test on. It becomes a pretty powerful tool. So I think we talked about the importance of having data that is clean, that is linked, that you understand probably more than anything else, because you will understand more about it as you begin to use it and you begin to test it. We talked about this isn't magic. It's not just about the technology. It's also about the people and the subject matter expertise that is involved in this. And then it really begins with a business problem. You have to have that hypothesis to test. And I think through the various studies, what we're all seeing is that the number of business problems that we can solve is growing exponentially and growing incredibly fast, which will bring with it a lot of questions that we're going to have to answer in the future. Questions around regulation, questions around IP protection, how do we actually use this information, when do we use it? There's a lot in front of us, I think, as this becomes more and more useful. So thank you very much for your insights. I mean, we're out of time, but I want to thank each of you for taking the time and to the group for submitting your questions and for being part of the discussion. So thank you.